Good afternoon, ladies and gentlemen. A very warm welcome to you on Business Today Television. The mood is buoyant on Dalal Street. We are on T-1 as far as the Nifty is concerned, ahead of its weekly expiry on Wednesday. About 73 points uptick on the Nifty at 24,620. The Nifty bank is flat for the moment. Lots of action coming into the IT index, up 210, and the broader structure of the market is in favor of bulls. About 1,500 shares are in the green versus 1,000 that are in the red. So that's an easy 2:3. For every 2 stocks in the red, 3 are in the green. Buoyant day in trade. Out of 19 indices, about 17 of them are in the green, and the rally, of course, is led by mid caps. The Nifty Alpha 50 index is up 1%, small cap 100 index is up 0.8%, and there is a massive rally, ladies and gentlemen, that's happening in defense counters such as Garden Reach, up 6.5%, in stocks such as Cochin Shipyard, the top traded counter, 3.4% higher today, 2,104. About 2,500 crores worth of shares have been traded on Cochin Shipyard, and of course the newest sector to join the rally is the railway space. So IRCON from the PSU stable is up 11% at 217. You have a strong move coming into RailTel, 11% higher. You have a very nice move coming into RVNL, 6.5% higher, and wagon makers, whether it is Titagarh, Jupiter Wagons or Texrail, all of them are in top shape. Now, ladies and gentlemen, this is the week of the RBI credit policy, which will happen on Wednesday. We are now joined by Mr. Mohit Khanna. He's the fund manager at Purnarth Investment Advisors, and he runs a mid-cap fund as also a multi-cap scheme. Namaste Mohit ji, a very warm welcome to you. How are you looking at sentiment on Dalal Street? This rally on defense counters, is it overextended at this point of time? Do you have a presence of defense stocks in your portfolio?
All right. Thank you so much, Shalinji, and good afternoon to all the viewers over here. Yes, it does looks like that the defense rally seems to be probably in the last leg over here. Well, it's always very difficult to call that out when things are in momentum. But I would rather refrain to put in any fresh money. But I would still, continue to ride the rally. That's the mood on the defense stocks as of now. Yes, we do have exposure on the defense stocks. A couple of names we have in the portfolio here, wherein we are quite confident of the improving margin profile and the order book that gives us the revenue visibility over the next couple of years.
Okay. Mohit, you manage about 150 crores in the mid-cap scheme at Purnarth Investment Advisors, and you have 22 stocks invested over that asset under management. How many of these are defense, and any broad structures that you can share? Maybe it's an electronics giant, maybe it's a shipbuilder, maybe it's an aeroplane manufacturer. If you can just give us a broad description of the defense stocks that you have.
So largely, we have just one defense name on the direct side, which is which is into aeroplane manufacturing, and we are very comfortable holding that, and we have not added to the positions in the very recently. I mean, we are not adding it right now, but we have been holding on to it, and we continue to make a decent set of returns on that.
Okay, let's look at the thought process that goes into constructing your mid cap portfolio, Khanna sahab. How are you? What is the 2 or 3 things that you're looking at in a investee company when you start research? What are the basic requirements at Purnarth in terms of its its structure of investments or its thought process?
Right. So in Purnarth, we have two very distinct verticals managing different PMSs. Just speaking about my fund, the mid cap fund over here, what we are trying to do is to balance the portfolio between the growth oriented stocks, the value oriented stocks, and the margin expanding stories.
Okay.
Right. This is the broad overview that we are looking at, that we look at. Now, if we come down to the growth-oriented stocks, I would rather like to have a stock which have revenue visibility in sense of order book over the next couple of years, so that I can be reasonably assured of that growth coming in. Secondly, what I would also like to look at, a cleaner balance sheet, or the growth should be financed largely through internal accruals over there. Thirdly, importantly, that the margins should be at least, in the stock should be at least base level should be maintained. They should not go down, so that my PAT growth, matches up with the revenue growth. That is one criteria on the growth aspect. The second aspect, which is the value, where we also play certain value unlocking tactical stories. That is very simple to understand. Something worth 10 rupees is available at 7. We try to understand the reasons why it is so, and then we can make a point, and if we could get the analysis right, that why it should go back to its mean or historical valuation levels. So, and then lastly is the margin expansion stories that we like to look at. Now, these kind of stories can happen due to raw material tailwinds, maybe better utilization of fixed assets, or maybe launch of continuous launch of new products at a higher margin. Now, one very important factor, when we come across, is that sometimes the growing companies are also expanding their margins at the same time. So these buckets sort of overlap with each other, and that's where we try to draw our comfort that more drivers are working in our favor.
Okay. Mohitji, what has been the CAGR of this mid cap fund that you run? How old is it?
So it's been little over 2 years we have been running the strategy. We are doing somewhere around 17.5% CAGR since inception on the strategy here.
Okay, so you launched in the middle of pain, as it were, as far as mid caps are concerned. Let's look at the sectorals that you address. Now, what is your view on the railway space? Of course, we have a very sharp spurt that is coming into railway stocks today. Let's ignore that for the moment. But what's the broader understanding that you have within the railway sector, and is there any representation in your portfolio as far as the railway theme is concerned?
Right. So if you see the railway sector's progress over the last few years, electrification as a drive has largely sort of over, right? And then there is a current focus by railways, especially on increasing the capacity and modernization. So, and the third is the security. So our focus, or our area of liking, is increasing the capacity on the wagon side, especially wagons, and the metro rail passenger coaches side, or Vande Bharat coaches side. That's where we think is the biggest new entrant, new story can develop over the few years, and we have seen this story or the theme getting more fortified with the announcement of newer players, announcing their entries very recently. We have been invested into the theme of wagon manufacturing for some time now, and we continue to like it. The most important aspect for me, having exposure over here, is that what we have seen in terms of order inflows, which was little slow last year due to elections and other disruptions. That order inflow till FY24 was very strong. 25 remained little weak, but I think now it should start to pick up. The disruptions are behind us, and we should see more orders coming in because the budgetary allocations in the especially in the wagon space have actually not declined for Indian Railways, and this is one space wherein we will continue to see the outphasing of older passenger coaches and introduction of newer Vande Bharat coaches across the railway ecosystem. Secondly, if you see the dedicated freight corridors that being developed by the railways, both on the western and the eastern side, they are now driving larger volumes, and we expect that the requirement of wagons should continue to increase for Indian Railways due to the increased volumes as the network effect comes into the picture for most of the commodity players or the other importers or exporters falling in those areas.
Okay. Uh, Mohitji, how are you looking at the healthcare space, in particular hospitals? The reason why I ask is this has been a secular rally that we have seen in many hospital stocks. Those listed recently are at record highs. Those with legacy hospitals are doing immensely good. Average revenue per operating bed is scaling up every quarter. Newer and better hospitals are coming up. This is something that India enjoys as even price differential with many Western countries, as also quality differential between Africa and our subcontinent. Is there a view that you will have on hospital stocks?
Yeah, we have one of the largest holdings as a hospital stock. We are up more than 100% on it, and we still continue to like it, right? See, the point with the story or the theme over here is that it has multiple legs, and the theme should extend itself over multiple years. Even from here on. The one of the primary reasons is that India has, sort of witnessed that the paucity of quality healthcare services during COVID times was one of the big realizations that we had. And therefore, a large part of investments, especially from the private sector, is coming into it. And we saw this from the PE and the unlisted side getting activity or getting activated a couple of years ago, and now is the time for the listed players to do well. If you see the whole ecosystem again, the rise in beds for and bed availability remains very good for the whole for all the listed players here, and the view or the next couple of years we will continue to see bed addition. Now, even when beds are being added, and you rightly pointed that out, the average revenue per bed, which is RPOB, continues to remain very strong, and the occupancy levels also continues to remain very strong. One of the reasons is that we identified was the penetration of health insurance, which basically is taking away a lot of worry from the Indian middle class in terms of the hospital bills and seeking better and good healthcare services. So, in that sense, we continue to like it. Also, if you look at the World Bank's number, which is the recommended number of hospital beds per thousand population, we are very low on that. So they recommend around 3 beds per thousand persons population. India is somewhere around zero point 0.8, zero point 0.9. So we have a long way to go. One thing that we must see as investors in equity markets is what are we paying for. So right now, if you see, the valuations might look a little bit stretched. That is one aspect, but due to the accounting differences the hospitals have, PE might not be the right way to look at the valuations because of the high depreciation they have to make on the newer addition in the hospital side. So I think we must focus on balance sheets. We must focus on cash flow generations by these hospitals and to assess the right investment. But the long story or the long term story continues to remain very, very intact. Also, one point over here is that healthcare services sort of largely remain recession proof. So it is also a newer avenue to hide in terms of higher volatility, which Indian investors have of lately discovered.
Okay. Mohitji, when you look at the broader thought process that you have in terms of mid caps outperforming large caps over the medium to long term, what is the view that you hold on the markets at this point of time?
See, end of the day, with the markets and the segments within the markets, whether the large cap, mid cap, or the small cap, will follow the earnings. And even if you look at the fourth quarter earnings, mid caps continue to deliver much stronger growth as compared to the large caps here. And if we look at the forward estimates at the consensus level, mid cap still continues to outshine in terms of the growth expectations as compared to the large cap. So my sense over here is this: yes, there might be certain pockets of overvaluation within the large mid cap space, but there also at the same time exist some opportunities which could be looked at from the 3 to 4 year perspective. And if anybody wants to build a portfolio over here, considering 25 or 30 stocks or 22 stocks, it's a good time to start with a strong bottoms up analysis. Overall, if you look at the markets, I think Nifty 50 should deliver somewhere around 15 to 17% earnings growth over the next 2 years, in which the FY27 could be slightly bigger in terms of that contribution, even when FY26 faces a favorable base due to poor FY25. So and if you look at the mid cap space, wherein we are expecting somewhere around 18 to 20% sort of a earnings growth and overall in the sector.
Okay. My final question to you, Mohitji, is that on Friday the Reserve Bank of India convenes its credit policy meet. What are your expectations from the central bank in terms of interest rates? Do you see another one in the pipeline?
I've read enough of 20 bips cuts expectations across the market, right? I am heading into this policy remaining neutral. I think central bank would like to wait and watch and see more details on how the tariff conversations are ongoing, or if there is any trade deal that is going to happen. On the other hand, if you look at the growth aspect, because inflation continues to remain benign for India, and that helps interest rates going down. But if you look at the growth aspects also, we have had a little bit of a positive surprise in the fourth quarter growth rates. And then subsequently, the GST collections have been little bit better than expectations in the last 2 months. So my sense is that RBI can wait for this round and can go in for maybe a bigger cut the next round of the policy meet.
Okay, Mr. Khanna, thank you so much for your time, and here's wishing you all the best for your mid-cap portfolio, and of course the newly launched one, which is the multi-cap one. Thank you for your time, and here's all the best for you.
Thank you so much.
That, ladies and gentlemen, was Mr. Mohit Khanna. He's the fund manager for the mid-cap scheme at Purnarth Investment Advisors Limited. Thank you so much for watching. I hope you enjoyed the conversation as much as I did. There's a lot that's happening on the other side of the break. Remain glued to Business Today Television. Thank you for your time.